Cash on cash return answers one question. What percentage yield am I earning on the actual cash I put into this deal? The formula: annual pre-tax cash flow divided by total cash invested times 100. COC equals annual cash flow total cash invested x 100. Annual cash flow is your NOI minus your annual debt service, mortgage payments. Total cash invested is everything you spent out of pocket: down payment, closing costs, rehab costs, and any other upfront capital. Example: you buy a duplex for $200,000. You put 25% down, 50,000 plus 5,000 in closing costs plus 15,000 in rehab. Total cash invested, $70,000. The duplex rents for $2,400 a month total, $1,200 per unit. Annual gross rent, $28,800. Operating expenses at 45%, $12,960. NOE, $15,140. Your mortgage payment on the $150,000 loan at 7% over 30 years is $998 a month or $11,976 a year. Annual cash flow, $15,840 minus $11,976 equals $3,864. Cash on cash return, $3,864. $70,000, 5.5%. Now here is why this matters more than cap rate for most investors. The cap rate on this deal is $15,940, $200,000, 7.9%. That number is the same whether you pay cash or finance, but your actual experience as an investor depends entirely on how much of your own money is in the deal. If you paid all cash, $200,000 plus $5,000 closing plus $15,000 rehab equals $220,000, your cash on cash would be $15,840. $220,000 earns 7.2%. Lower than the leveraged version, but with zero debt risk. If you found a lender willing to finance 90% of the purchase, your cash down drops to $20,000 plus closing plus rehab equals $40,000. But your mortgage payment is higher, $1,197 a month on $180,000. Annual cash flow drops to $1,476. KOC, $1,476. 40,000, 3.7%. Less cash in, but also less cash flow and more risk. This is the fundamental trade-off of real estate investing. More debt means less cash in the deal and potentially higher returns on your cash, but also higher risk, tighter margins, and less room for error. Cash on cash makes this trade-off visible. What is a good cash on cash return? Most investors target 8 to 12% for buy and hold rentals. Below 6%, and you start asking whether the hassle of being a landlord is worth it versus just putting money in an index fund. Above 15% usually means you found a genuinely good deal or you are underestimating expenses. The beauty of COC is that it is personal. It measures your return on your money in this deal, not some theoretical yield, not an industry average. Your cash, your return.